In 1875, the Ottoman Empire owed 214 million British pounds to European creditors. That is the equivalent of roughly 26 billion pounds in today's money. But here is the number that should stop you cold. The entire annual income of the Ottoman Empire that year was just 21.7 million pounds. They owed 10 times more than they earned in a year. The greatest Islamic empire in history, a state that had once terrified all of Europe, that had conquered Constantinople, besieged Vienna, and ruled from Algeria to Iraq, was not destroyed by an army. It was destroyed by a loan. And the men who gave that loan, a network of bankers operating out of a single neighborhood in Istanbul, would end up controlling a quarter of the empire's tax revenue without ever firing a shot. This is the story of how the Ottoman Empire died of debt, and the bankers who conquered the Sultan. This is Professor Blackwell, the channel where empires are exposed and the real history of money and power is finally told. If you are not subscribed yet, now is the time. Hit that button and ring the bell, because what we are about to uncover today is one of the oldest tricks in the Book of Power. You do not need an army to conquer an empire. You just need a checkbook. So pour yourself a coffee. Close the other tabs. Give me your full attention. Because the death of the Ottoman Empire was not a sudden collapse. It was a slow financial strangulation that took decades to complete. And the fingerprints of the men who did it are all over the receipt. To understand how the Ottomans fell into the debt trap, you first have to understand what the empire looked like before the loans began. For centuries, the Ottoman Empire was one of the wealthiest and most powerful states on earth. At its peak in the 16th and 17th centuries, it controlled southeastern Europe, Western Asia, and North Africa. It commanded the trade routes between East and West. Its capital, Constantinople, which the Ottomans called Istanbul, was one of the largest and richest cities in the world. The Ottoman treasury was funded by conquest, trade, and an elaborate tax system that stretched across 3 continents. And for hundreds of years, the Ottomans had a policy that set them apart from every other major power. They did not borrow from foreigners. The sultans understood, instinctively if not intellectually, that foreign debt meant foreign influence. If you owe money to another country's bankers, those bankers have leverage over you. And leverage, in the world of empires, is just another word for control. So, the Ottomans avoided it. They debased their currency when they needed money. They printed banknotes. They taxed their subjects harder. They borrowed from domestic lenders. But they did not take foreign loans. That policy held for centuries. And then, in 1854, it broke. The Crimean War changed everything. The Ottoman Empire found itself at war with Russia, fighting alongside Britain and France. Wars are expensive. The Crimean War was extraordinarily expensive. And for the first time in its history, the Ottoman treasury could not cover the costs with domestic revenue alone. The Galata bankers, the network of merchant families, who had been lending to the Ottoman government for generations from their base in the Galata district of Istanbul, did not have enough capital to fund a full-scale war. The empire needed money from outside. And so, in 1854, with the encouragement and guarantee of its allies, Britain and France, the Ottoman Empire took its first foreign loan. It borrowed from Rothschild and other British financiers. The British banker was also given privileges to establish a bank in the empire. In 1856, the Ottoman Bank was founded in Galata, headquartered in London, with capital from a British financial group. By 1863, French stakeholders had joined, and the bank was renamed the Imperial Ottoman Bank. It functioned as a central bank, a commercial bank, and an investment bank all at once. It was even granted the right to issue currency. A foreign-controlled bank, sitting in the heart of the Ottoman capital, printing the empire's money. The door that had been closed for centuries was now wide open. And it would never close again. The first loans seemed manageable. They were backed by the British and French governments, and the terms, while not generous, were not catastrophic. But the problem was what came next. Having tasted the ease of foreign credit, the Ottoman government could not stop. New loans were taken in 1858, 1860, 1862, 1863, 1865, and then every single year from 1869 to 1874. Each loan was larger than the last, and the terms got worse every time. Here is a detail that makes the blood boil. The Ottoman Empire did not even receive the full face value of its loans. European banks would issue Ottoman bonds at a discount, sometimes as steep as 40 or 50%. So a loan with a face value of 100 million francs might only deliver 50 or 60 million francs to the Ottoman treasury. But the empire was still obligated to repay the full 100 million, plus interest. One analysis estimated that while the Ottoman Empire's total debt reached 5.3 billion francs on paper, the actual amount of money the Ottomans received was only about 3 billion francs. The empire was being charged interest on nearly 2 billion francs it never received. This was not lending. This was extraction disguised as finance. Here is how the system worked. And this is the part that Professor Blackwell finds most revealing. When the Ottoman government wanted to borrow money, it did not go directly to foreign banks. It went through intermediaries, the Galata bankers. These were families, many of them Greek, Armenian, and Jewish, who had been operating in Istanbul's Galata district for generations. They had connections to the financial centers of London, Paris, and Vienna. They understood both Ottoman bureaucracy and European banking, and they positioned themselves at the center of every transaction. The Galata bankers were not ordinary money lenders. They were political operators. Their influence extended far beyond finance. They had connections inside the Ottoman court. They funded the lifestyles of governors and ministers. They financed military coups when it served their interests. During the Tulip era, a period of artistic and cultural flourishing in the early 18th century, the Galata bankers helped fund an uprising that overthrew the government because the Sultan's monetary policies were cutting into their profits. They could make or break careers. A provincial governor who wanted an appointment needed money for bribes. And the only people who could provide that money on short notice were the bankers in Galata. Once a governor owed money to a banker, that banker owned a piece of every decision that governor made. The Galata bankers would arrange the foreign loans, take a commission, and then lend additional money to the government themselves at even higher interest rates. When the government could not repay a loan, the bankers would arrange a new loan to cover the old one. Debt was used to pay debt. Interest piled on top of interest, and the bankers got richer with every transaction, regardless of whether the empire's finances improved or deteriorated. In fact, the worse things got, the more the bankers profited, because distressed borrowers pay higher interest rates. And what did the Ottoman government do with all this borrowed money? This is the tragedy of the story. Very little of it went into productive investment. Some went to building railways, which was useful, but much of it went to paying for the lavish lifestyle of the imperial court. Palace construction, imported luxuries, ceremonial expenses, and a significant portion went straight back to the Galata bankers themselves, to repay previous loans that were coming due. It was a spiral. Borrow to spend, borrow again to repay. Each cycle deeper than the last. The corruption of the Ottoman tax system made everything worse. Provincial governors would borrow money from Galata bankers to pay the bribes needed to secure their appointments. Once installed, they would squeeze their provinces for tax revenue to repay those loans. The tax money that should have gone to the central treasury was being siphoned off at every level by a network of officials and financiers who were more interested in personal enrichment than in the health of the empire. By the early 1870s, the Ottoman debt had reached staggering proportions. The empire owed money to creditors in Britain, France, Austria, Germany, Italy, and the Netherlands, as well as to the Galata bankers domestically. The annual cost of servicing the debt, just paying the interest, consumed more than half of all government revenue. Think about that. More than half of everything the empire earned went to paying interest on loans, not building roads, not equipping armies, not feeding people, just interest. And then the world economy crashed. The Panic of 1873 was a global financial crisis that began in Vienna and swept across Europe and North America. Stock markets collapsed, banks failed, credit dried up. For the Ottoman Empire, already stretched to the breaking point, it was the final straw. The European markets that had been so eager to lend money to the Ottomans suddenly slammed their doors shut. New loans became impossible to obtain. And at the same time, a series of droughts and floods devastated Ottoman agriculture between 1873 and 1875, destroying harvests and wiping out tax revenue across entire provinces. The economic crisis was not confined to Istanbul. It rippled across the entire empire. In Egypt, which was technically an Ottoman territory, the Khedive Ismail had borrowed just as recklessly as the Sultan. He had taken massive loans to fund the construction of the Suez Canal and the modernization of Cairo. When the debts became unpayable, Ismail was forced to sell Egypt's shares in the Suez Canal to the British government for £4 million. It was one of the most consequential fire sales in history. Britain's purchase of those shares gave it effective control over the most important shipping route in the world, a route that connected Europe to Asia and that had been built with Egyptian labor and European capital. The canal that was supposed to make Egypt rich instead became the instrument of its colonization. By 1874, the situation was so dire that the Galata bankers refused to lend to the Ottoman government, even at 25% interest. 25%, they had calculated that the risk of default was so high that no interest rate could justify the loan. When your own bankers will not lend to you at any price, you are finished. On October 6, 1875, the Ottoman Empire did the unthinkable. It suspended payments on its foreign debt. The empire was bankrupt. The total amount owed was estimated at 214 million British pounds. The entire annual income of the empire was just 21.7 million. For comparison, the modern debt-to-income ratio of the United States is roughly 7.8. The Ottoman ratio in 1875 was nearly 10-1. The empire owed roughly a decade's worth of income to its creditors, and there was absolutely no way to pay it back. The reaction in Europe was fury. British and French bondholders, ordinary citizens who had invested their savings in Ottoman bonds, were outraged. They demanded that their governments intervene. Meanwhile, the empire's problems continued to multiply. In 1877, just 2 years after the default, war erupted again. The Russo-Turkish War saw Russian armies push deep into Ottoman territory, advancing so far that they reached the outskirts of Constantinople itself. A British fleet of warships rushed to the area and deterred the Russians from taking the capital. But the war devastated what was left of the Ottoman treasury. The government could not even pay salaries to its soldiers and civil servants. The empire that had once struck fear into the heart of Europe could not make payroll. A peace treaty was imposed on the Ottomans in 1878 at the Congress of Berlin. The great powers of Europe, the very same nations that had been lending money to the Ottomans for decades, sat around a table and began dividing up Ottoman territories among themselves. The debt had not just bankrupted the empire, it had given its creditors the moral and political justification to carve it up like a piece of meat. And then came the final humiliation. In 1881, after years of negotiation, the Ottoman Empire was forced to accept the creation of the Ottoman Public Debt Administration. This was an institution unlike anything the world had seen before. It was staffed mostly by Ottoman subjects, but it was controlled by a council of 7 representatives, 1 from France, 1 from Britain and the Netherlands jointly, 1 from Germany, 1 from Austria, 1 from Italy, 1 representing the Ottoman government, and 1 representing the Galata bankers. 6 of the 7 seats were held by the empire's creditors. The Ottoman government had 1 voice out of 7 in the management of its own finances. The debt administration was given direct control over approximately 1/4 of all Ottoman state revenue. It collected taxes on salt, alcohol, silk, tobacco, fisheries, and stamps. These were not minor revenue streams. They were among the most profitable taxes in the empire, and the money collected did not go to the Ottoman treasury. It went directly to the bondholders in London, Paris, Berlin, and Vienna. A foreign institution, sitting in the heart of Istanbul, was collecting Ottoman taxes and sending the money to European investors. The empire was still technically sovereign, but in practice, 1/4 of its economy was now controlled by foreigners. And the debt administration did not just collect money, it became a state within a state. At its peak, it employed over 5,000 people. It had its own offices, its own bureaucracy, its own enforcement mechanisms. It operated more efficiently than most Ottoman government agencies. European creditors had effectively built a parallel administration inside the empire, one that served their interests first and the empire's interests second, if at all. This arrangement lasted for decades. The Ottoman Public Debt Administration operated from 1881 until the empire itself collapsed after World War I. For over 30 years, a significant portion of Ottoman economic life was run by and for European bondholders, and the political consequences were enormous. Foreign governments used the debt as leverage to extract concessions, railway contracts, mining rights, trade privileges. The debt was not just a financial burden, it was a tool of imperial control. The British, French, and Germans used their financial power over the Ottomans to carve out spheres of influence that would eventually be formalized in the treaties that dismembered the empire after 1918, when the Republic of Turkey was established in 1923 under Mustafa Kemal Atatürk. One of the first challenges the new state faced was the Ottoman debt. At the Paris Conference of 1925, Turkey agreed to pay 62% of the empire's pre-1912 debt and 77% of the post-1912 debt. The negotiations continued for years, and in 1933, Turkey reached a final settlement, agreeing to pay 84.6 million liras of the remaining 161.3 million. The Republic of Turkey did not finish paying off the Ottoman Empire's debts until decades into the 20th century. The loans that began in 1854 cast a shadow that lasted nearly 100 years. And here is the lesson that Professor Blackwell keeps coming back to. The Ottoman Empire was not conquered by a foreign army. It was conquered by compound interest, by bankers who understood that a loan at the right moment, to the right borrower, under the right conditions, is more powerful than any cannon. The Galata bankers and their European counterparts did not need to storm the walls of Istanbul. They just needed to offer a loan that the Sultan could not refuse. And then another, and another, until the empire was so deep in debt that it had no choice but to hand over its own tax revenue to the men who had financed its destruction. This pattern, an empire borrowing its way to collapse, is not unique to the Ottomans. You can see it in Egypt under Khedive Ismail, who sold his shares in the Suez Canal to Britain because he could not pay his debts. You can see it in China under the Qing dynasty, which was carved into spheres of influence by European powers using debt as the knife. You can see it in dozens of countries today, trapped in cycles of borrowing and repayment that leave them sovereign in name but controlled in practice. The Ottoman Empire lasted over 600 years. It survived plagues, crusades, invasions, and civil wars. But it could not survive the compound interest on a series of loans that its sultans should never have taken. The bankers did not conquer the sultan with swords. They conquered him with spreadsheets. And by the time anyone realized what had happened, the empire was already gone. The buildings still stand in Galata. You can walk through the old banking district today. The stone facades are elegant. The architecture is European. And if the walls could talk, they would tell you the story of how a handful of families, operating from a single neighborhood, helped bring down one of the greatest empires in human history. Not with guns, not with armies, with money, just money. And now you have seen the full ledger. Every loan, every interest payment, every commission skimmed off the top. Every tax that was collected by foreigners and sent across the sea to bondholders who never set foot in the empire. This is how empires really die. Not on the battlefield. In the bank. Not with a bang. With an interest payment that nobody could afford. And a signature on a loan document that should never have been signed.